Welcome to the Options Are Easy trading platform, powered by ORE. In this 5-minute lesson, I will show you how and when to buy a call option. First, let's consider why you would want to buy an option. The main benefit is that you can trade in the Forex gold or oil markets on a limited risk. This is because the price you pay for the option is your total investment size. So you have the security of knowing exactly how much of your funds are required before you open a trade. Also, you do not need to utilize a stop loss order to manage this limited risk. Hence, you avoid being stopped out on large market swings. Now let's consider how an option allows us to make these limited risk trades. Well, when you buy a call option, you hold the right to buy at a certain market price over a certain period of time. Say, for example, you're interested in trading gold. By clicking into this box and entering the gold symbol, that's XAU to US dollar, and you can see the price at the moment to buy is $1,161. Now say you're interested in buying gold over the next week, but you're concerned that this price will rise, and it will cost you a lot more than the current value of 1162. So what can you do in this scenario? Well, you could buy a call option, because the call option guarantees you the price of gold any time in the next week. Even if the price moves up by $100, you'll still be able to buy at the price that you reserved. So let's set up this option and see how it looks on the trade ticket. First of all, you need to select gold from the pair list. In the second box, we select the option type, which will depend on the direction we are trading. And since we expect the price of gold to move up, we would choose a call, because a call option gives us the right to buy. This next box is where we enter our strike. We can also refer to the strike rate as our target rate. And the options payout depends on how much this rate can beat the market by expiry. Say we choose a target rate of 1,170, so slightly above where the market is currently trading. And subsequently, on opening this option, the market rises to 1,180. It would mean that via my option, I can buy gold at a price that's $10 cheaper. And the more the market moves up, say gold moves to 1,200, 1,250 and so on, the more the market moves up, the more valuable my option is becoming, because my option strike is allowing us to buy at a cheaper price. The next box is the expiry date. We can enter a duration of 1 day all the way up to 6 months. On expiry, your contract will be closed automatically at 10 a.m. Eastern Standard Time. When the option is closed, the profit or loss from the trade will be reflected in your account's balance. But you do not have to hold the option until expiry. You can close it at any time beforehand to lock in profit or to reduce a loss. For this example, we're going to choose an expiry of 1 week, 7 days. Now, the last step is the amount. This is simply the amount of gold you would like to buy. So here, if I enter 10, that is for 10 ounces of gold. In summary, I have set up a call option that gives me the right to buy 10 ounces of gold at a price of 1,170 over the next week. And you can see that this option costs me $68.79 US. If the price of gold were to rise above my strike, my target rate of 1170, then the value of my option will also rise and I may make a profit. But on the other hand, if the price of gold does not rise, then I will make a loss. And this loss is limited to the price of the option. Now let's consider the profit potential of this trade, which you can do so by clicking on the Scenarios button. This will present you with a chart and a table showing your potential profit or loss over a range of market rates. The vertical axis is your profit or loss. The horizontal axis is the market rate. You can choose to analyze the present payout of the option or the payout at expiry. Here, by looking at the payout at expiry, you can see this grey zero line, which is your break-even point. Blue line showing you the current level of the market, and you can see your maximum risk is the price you pay for the option. Now, looking at this chart, there is a very clear pattern. As the price of gold rises, you see profit from the trade is also rising. And on the other hand, as the price of gold falls below the strike rate of the option, a loss is made, but this is limited to the price you paid for the option. And no matter how low the price of gold moves, you will not be stopped out. So it means that gold could fall before it rises and you would still be in the position to make a potential profit. If you are happy with the trade, close the scenario tool and click Trade Now. The trade will be opened in your Open Positions page, and from here you can monitor the running profit or loss. You'll see the amount you paid for it, that's $69, and you can see the amount that the trade is currently worth. And as your option contract becomes more attractive, the premium now, the value of the option, will rise. To find out more and learn how to trade Forex, gold or oil options, visit ore.com.